Okay, looks like we are live. Looks like my sound is working. Looks like connection. Okay, welcome everybody to Midas Investing Live, Friday afternoon. It's been a few weeks. I know I'm a little late. I think it's been like 4 weeks, maybe it's 3 weeks, 3 or 4 weeks since my last show. So a little bit behind the desired schedule, but watch my cat going in front of the screen real quick. In fact, my cats are being a little extra right now, so hopefully they don't cause any problems. But anyway, good to be back on stream. See you guys a little bit. Interesting stuff to talk about today a little bit. Hopefully, or probably not going to go too long. How I say hopefully on my end, because I don't really want to go too long, although sometimes I end up rambling a lot and then going longer than expected. So we'll see how quickly things move. Okay, come on, move. Sorry, my cat cannot figure out which side of the desk she wants to be on right now. But anyway, so we're gonna talk about a few things here today. We're gonna chat a bit about interest rate policy, I guess. Really, that would probably be kind of one of the shorter parts of the discussion in comparison, I guess. But obviously, with see on the thumbnail, big news: Jerome Powell in the last FOMC conference, where they announced that they were not going to cut interest rates or really change anything about monetary policy for the most part in the short term. But we also got the confirmation from Jerome Powell that he is planning to stay on the board of governors after his term ends, and that was his last meeting. So we will be getting hopefully the confirmation for Kevin Warsh, our selected nominee, here at some point in the near future. And various hurdles have been moved for him. Come on, move. Sorry, my cats are just so extra right now. But yeah, so anyway, I pulled up here the Fed Watch tool, and you can see here's the implied path of the Fed Fund futures rate over the next like 2 years or so based off of the futures market. And you can see it's basically flat. There is this kind of weird little deviation here, which sometimes just like there's weird daily fluctuations that'll cause like a weird misalignment like that. So when you see something that looks strange and doesn't make sense, it's probably because it's not really substantially there. And so you can kind of just ignore that a little bit. But go. All right, go. Come on, Missy. You gotta figure out what you're doing. Seriously. My cat. She thinks I'm talking to her, I think. I think that's the... She's like, well, you're talking to me? But anyway, so the point is, as you can see, the market does not believe that we're going to be getting Fed rate cuts anytime in the near to midterm future. And this, I mean, I'm talking about this after talking about Jerome Powell saying he's going to stay on the board of the governors, but really that doesn't have anything to do with that. That has more to do with obviously the conflict going on and the shock to energy markets and concerns about what that's going to do for inflation in the kind of short to medium term. So, looking at oil prices here, they're kind of still hanging around in that kind of same range that we've been in since the conflict started. So that's at least sort of a good sign that we haven't really reached new highs pretty much ever since the conflict started in terms of like the intraday level. Obviously in terms of daily closes, it was around the beginning of April that we had our peak there. So just kind of like floating in this trade range right here. I don't have a chart to show on this, but I have seen or heard other people discussing that if you look at like 3-month or 1 year forward futures prices for oil rather than just like the 1 month forward price, which is what this typically is, then you do see a little bit more stickiness there. So there's definitely still some signs in the oil market that there can be concerns about like the kind of medium term level of where it's going to go to, which has to do with questions about whether or not the strait will be opening or not. I had seen some pretty good data showing like all the different ways that the oil flows have been mitigated by various releases from reserves, or bypassing the strait by using pipelines, or increases of production from other areas. And the last time I saw the data was like 2 weeks ago, and it had showed that we had basically mitigated about 40% of the effect of the Hormuz flows. It's worth noting that 40% of the flows out of Hormuz does not mean that you are fixing 40% of the price problem because of the inelasticity of prices. So it could be that, like, for example, all the current prices we have right here could have already had assumed that 40% worth of mitigation. So it doesn't necessarily imply fixing of the problem. So just want to clarify that when I say 40% mitigated, that's not to imply that 40% of the problem is mitigated. It's just saying that, like, in terms of the current state, that was what was done. And there's some reason to believe that we can go much further than that if given enough time, but that's basically what the market was able to do with about a month and a half worth of dealing with this crisis. It's like, give it another 6 to 12 months, and I'm sure the market could bypass a much more substantial amount of the flows from the Hormuz. But then by that point, you would also have some more substantial damage to various economies around the world. And I say various economies around the world because it is worth noting that it's gonna the damage from this kind of energy shock is definitely going to hit different economies at different levels, based off of, you know, their ability and need to import those energy flows, and how expensive that is for them, and their ability to kind of like compete with other people for the same product. And also, we are looking at, this is WTI oil, which I've kind of pointed that out before. We're talking about oil, that I always tend to look at WTI oil, which is West Texas Intermediate, and by the name, it should kind of imply to you that that is a U.S. oil price. And so there is other oil prices. For example, the Brent crude oil price is one of the other major benchmarks used globally, and this one is technically a European North Seas price, but it is a much more global benchmark relative to WTI. And so, like, another thing to kind of keep an eye on in terms of trying to think about where the markets seem to, what the markets seem to be thinking about the crisis, is you can kind of take a look at between the two, Brent minus WTI, like where is that premium currently? So like here, going back to 2022, I wish I could get, should be able to get that for a longer. This Black Bull place is maybe not the greatest place to look at it, but let me find maybe a longer chart. But anyway, the point is like the spread is higher than normal, and that is, I don't really know a lot of these like sources for the prices. So that's the thing. Should have pulled this up before I okay, that still didn't really fix my problem. But either way, man, I wish, what was the chart that I was looking at earlier? I was literally looking at this earlier. Anyway, the spread is normally like $2 to $4, and right now it's like easily double that. If I could find like a good chart for it. But I'm just gonna go back to the normal oil price right now. Forget that I even brought that up. I'm not going to show you it, but you can look at it. It is above normal right now. But it also has, again, not continued to make new highs. So that's one of those things where it looks like the market's perceptions of the energy shock is contained, but still concerned. And then another thing that I was looking at that kind of shows where these concerns are going to hit is like jet fuel prices. Was it the Platts one, the one I was looking at? Gulf Coast. Man, where was the one I was looking for? Looking at. That was the Gulf Coast one, but GFC. It's like when you're looking at futures prices on TradingView, it'll like have a lot of these listed, but then you still can't actually click on them, which I find a little frustrating. Oh, this is the one I was looking at. There we go. Jet fuel prices. So you can see, like, similarly to oil prices, jet fuel prices have spiked up, and they're, I would say, a little bit closer to that peak level, but still kind of hanging out around there. But this is kind of like where you can see that flow through to actual damage in the economy. And so, like, within that, I would say that paying attention to data related to actual transportation in the economy is going to be kind of like a good guideline of when this damage is really starting to hit. Here, I'm trying to find another data set that I should have pulled up before starting the stream, but as you can see, I kind of started the stream right from getting home from work, so didn't necessarily have as much prep time as I often do going into these streams. But another thing I've been paying attention to since the start of the conflict is this website. If you just like search OAG airline prices, you can find the site very easily enough. But I had never even heard of this particular metric before the conflict. Like I said, I went looking for this data when the conflict began because I was talking to some friends who were concerned about this. So I was like, okay, well, let me see if I can find some airline price data and start tracking this. And I found this, which this website updates every week, which is pretty cool. But here it shows kind of like the yearly path of airline prices for the last 6 or 7 years, which is pretty cool that it gives it kind of like this, showing you like the usual pathway over the course of the year, which as you can see is pretty typical that we have some higher prices during the summer, or at least for this particular cluster of years, because worth noting that if you look at like just 2019 and 2020, which it also allows you to deselect these, which is kind of cool. So just looking at like 2019, you can see the prices didn't necessarily have as big of a hump going back to that. So if we think of this as like pre-COVID normal, right, and then kind of like maybe put the rest of them back in prior to this year, you can see that there is sort of a general hump here in the middle of the year. And then looking at where we are currently in this year, you can see once the conflict began here in March, we did get a spike up well above the kind of normal level within the year. But that has actually come down a little bit since then. And also I would point out that this high is nowhere near the peaks that we are seeing here. And it is also worth noting that those peaks were in a year 2022, which is when we had the last big oil price spike, as I was talking about before in the last stream we did, when I was kind of making the comparisons between it, because I think it is, might as well look back to a very similar kind of circumstance that we literally only had like a few years ago when looking at this crisis, because it can kind of show you how the market can kind of like deal with the crisis and make it so that it never really quite arrives. So here's oil prices and jet fuel prices again back in 2022 comparative to now, and then going back to the airline prices. So I've been watching this every single week, and now it's worth noting that the price isn't going to tell you everything, because the price isn't going to take into account demand. So like if there's more demand destruction being caused by the higher price, then that means that the price is going to stabilize, right? So you do want to kind of think about other data outside this. So other data, obviously, you can look at just the gasoline prices, which I didn't actually pull up gas prices, but let me pull that as well. But gasoline prices, which obviously, yeah, they're pretty high up here for 45 for the national all regulations US average, and that is an average. It varies quite a lot depending on which state you're looking at. I know my personal prices are definitely above this number. For example, I paid for gas yesterday or the day before, and it was above that number. So that is with that. But also keeping in mind that when thinking about this, this is not how the consumer feels inflation, but at the end of the day, this is technically how it impacts their wallet. Is actually an inflation adjusted gasoline price. And so on an inflation adjusted basis, we're technically not that high because we were coming off of such a low base in the first place. Again, that doesn't mean that we won't get there, because coming back to just that normal number, it was reaching. Take it off the monthly data set here. Back to the weekly. But it was literally spiking literally only into this last week here. So like, you can see like it, unlike with the oil price, which kind of reached that high and then has come back down, and then with jet fuel prices and reached that high and come back down, you can see gasoline prices have not done that. Gasoline prices have reached a kind of local high, came down a little bit for a week or two, and then have continued moving upward. But that's also partially a percentages thing. If I just take like the percent change, right, it's up 42% from a year ago as of right now. But if I do like the same thing with oil prices, well, it's at 95, and if I just look at like March 2025, it was at 66 or so, or well, we're at April or May, my bad. I don't know why I'm looking at March. Time flies. But like, yeah, late April, early May, we were down here at like $60. So at $95, it's over 50%, right? So you can see like this percentage change in gas prices is partially continuing to go up because it hasn't really fully made the full move there. And then, as I know, I harked on this point a little bit during the last stream, which is to say that it tends to spike up and then whittle its way down. So it's one of those things where it's like once you get the spike in inflation, it does kind of push its way towards an actual almost a cycle of disinflationary effects as time goes on. But anyway, come back over here. I kind of detoured to talking about gas prices there, but other data you can kind of watch on a somewhat regular basis. This data only comes out monthly, but I'm going to show you like 3 different groups of data. So that means it kind of shows this data will show up 3 different times during the month because it's different data series. But here we have the moving 12-month moving average for total vehicle miles traveled in the United States. And I have it on a percent change year-over-year basis. And then total vehicle miles traveled on multiplied by 12. I'm kind of making an annualized monthly number there. That their set begins in 1990. But so you can kind of like look at how the numbers zigzag there. So you know what that data set is. Zooming in here on the last like 3 years or so, and kind of looking at this, you can see, obviously we have it as of March, so that's really just the first month into the conflict. And so that's kind of what I mean. It's like this data comes out at a little bit of a lag here at the start of May, and we only have March data, and I'm not 100% sure when the next data point comes in. Let's see. Yeah, see, like this one just came out only a couple days ago. So that means it basically is like a month, almost a month and a half on a delay here. But nonetheless, going back to here, you can see like when this causes a recession to be dragged in is when you have a very substantial decline or when it's already negative. So you can see like some recessions begin when it's already still positive, but it's coming off of a much higher level there. And so that's what I'd say is like we're kind of starting from somewhat of a low level in terms of the growth. You can see like the kind of that 12-month moving average number here for the last few years has really just been sitting at like 1.5% or so year over year. And you can see like, yeah, the zigzag zigs and zags a lot. But yeah, so like looking at this, watching this, I'm going to be watching the kind of the monthly levels and see like how many kind of negative months we get in there. Like I said, we only have 1 month into the conflict so far for this particular metric, but it certainly hasn't really budged. And I'd like to see like, what does this look like once we get the April and May numbers? Because once we have like the May numbers, then we'll have kind of like a three month kind of period to look at for that. So moving on from that though, kind of similar, but for airline miles, like this was car miles. And so here I'm looking at also airline miles. I have it separated into domestic flights versus international flights, and this is specifically only U.S. air carriers. It's worth noting this, so it doesn't include data from foreign air carriers because this is U.S. data, and so that's kind of how they collect it is regulatorily, right? So if I kind of go back here, you can see, yeah, I mean, COVID was an insane period here. Like literally, I mean, you can't see it, but this is percent change, and so like down here, it's literally like 87, 88. 98% drop in COVID for these, and then so we get a 1800% spike up. But if I kind of just come back here to try to show you like pre-COVID, you can see pre-COVID still very volatile. I was like even just like showing here like post GFC, these are at least kind of like single to only barely double digits or somewhat negative there. So this kind of gives you at least somewhat of a more normalized time frame, I would say. And here you can see very volatile, but it's worth noting that this is also after 9/11. So other reasons why there was a big drop off in air flights, at least temporarily, and then causing a little bit of a volatile kind of comeback period right there. So then kind of zooming back forward again to the last couple of years here, really you have to zoom in on like the last 2 or only even 1 year because the recovery from COVID was just so steep there. But you can see that, yeah, like the international level had kind of like leveled out at like 2.5 to 5% for the last few years. And this data, is this only as of January? Okay, this one's only as of January. That sucks that it's that much of a delay on this. Let me find out when it reports. The reports at the beginning of the month, and we just got it in May. So that means we'd be getting February and June, which means we'd be getting March and July. So yeah, that definitely sucks that this data comes out at a little bit of a lag, but I actually feel like this, the airline data is probably a little bit better of an idea of like when it's really the energy crisis is really starting to break the economy even faster, I think, than the auto data. So still useful to look at, but it definitely has a little bit of a delay there in terms of that. And then here you can see that the domestic air carriers, I mean, that's been flatlined since like mid 2024, interestingly enough. But still, we'll want to see how that comes out, like I said, in a few months once that kind of starts to come through. But yeah, I didn't realize this one was as much a delay. Like I had known this one was coming in at like a month or a month and a half delay, but I didn't realize this one was as much of a delay. But that kind of sucks. But either way, like just things that you can kind of compare with the oil prices and with the gas prices and with the jet fuel prices and with those airline prices. Like I said, it's like you can kind of take all this data together. Some of it coming out on a weekly basis, some of it daily because it's market prices. And then some of it on monthly basis, but data that you can look at to get an idea of like when things are starting to break. And so far, okay. I'm not gonna call it good. It's not good. It's not great, but things are okay, I guess. We'll call it that. In the interim here in the last week, we did also get GDP prints. So here, I'm pretty sure I've showed this before. It's like we have the real GDP on kind of the quarterly basis, which is the headline number, and then I kind of show it on a year-over-year basis because I like showing on a year-over-year basis. It kind of gives you a better idea of like what the trend is. It's very, very delayed, but it gives you an idea of like what is a normal GDP number, because the quarterly number that they report in the headlines, it'll go from 0.5 to 3.5 to 1.5 to 2.5 to 0 to 4.5, and it'll like jump around a whole lot. When really like the year-over-year level is at like 2.5, and it stays pretty stably around there. So I like to look at that. And then the alternative methods I like to look at, like consumption plus private investment, final sales to private domestic purchasers, and then also gross domestic income, which is kind of like a cousin metric. And all of those on a year-over-year basis gets you an idea of like where is kind of the general trend of growth, and to compare with that kind of quarterly number. So zooming in though on the last few years here, so you can see like what's recently happening. So yeah, we got the quarterly print here for Q1, and it came in at like 0.8. Oh my bad, that was like 0.48 was last quarter. 1.99, so a little under 2% was what we got for Q1. I was thinking of a different number for the 0.8. But you can see like this general trend for these other metrics though. You can see they kind of all cluster in around like high ones to high twos. So, kind of take an average between all of them and you get like 2.25 or so, 2.25, 2.3, something like that. If you was to just kind of like average out those four different year-over-year metrics. So because it gives you an idea, like that's where we're currently hiding out at, which is, so Q1 was maybe a little bit low in terms of that trend. Q4 was particularly low in regards to that trend, but that's partially because we had the government shutdown. So, Strait of Hormuz is definitely impacting Q1 as well. And expectations, it'll probably impact Q2 as well. I like to look at the GDP now metric that the Fed provides, which is like basically their statistical nowcasting method using data prints that come out. And then there's the St. Louis Fed news nowcast, which basically does the same thing but with news headlines. And then I've kind of did some statistical work and found that like if you do literally just like a double weighting of the GDP now with a single weighting of the newscast index and put all of them together, and it actually correlates with that quarterly print of GDP at like, I think it was like 60-70% explanatory power is like really, really strong actually. In terms of that. So I was like, this is actually maybe a really good proxy in terms of like trying to get a guess of what the next GDP print is going to be. So with that, I mean, they already have an estimate for Q2 that literally they only like put it out in the last week or so. So it's based off of only 1 month worth of data. It's worth noting 1 month worth of data that we have 1 week's worth of releases for, when each of these past data points ends up being 3 months worth of data that they have 4 weeks worth of trailing for. So it's worth noting that like the reliability of this Q2 number is only like 1/3 to 1/4 of what the final reliability will be, which the final number is for each of these predictions is basically put in I think it's like 1 week before the actual GDP number comes out. So there's a lot of lag, basically. Like they update this number all the time. Long way to say it. It's a lot of caveating to say that it currently shows 3.16 for the Q2 GDP growth. So that would be very strong growth of a bounce back to have during the Hormuz situation, I would think. Granted, there could be some logic as to the energy exports from the United States to the rest of the world could be part of the reason that that would be buffeting that. But anyway, my caveats on that was to say that that's what they are saying the estimate is right now. If we check this same number a month from now, which would still be like 2 months before we know the actual GDP number, but by that point, this could be significantly lower. It tends to move around until it gets to that final print. So, but anyway, yeah. So like I said, we don't like the energy shocks. We don't like big supply imbalances globally and all that jazz. But at the same time, the economy is seeming to withstand it, at least in the short to medium term. We will point it out when things really start to change on that front. And then, I have my own kind of nowcasting tools I like to look at. This is my earned income proxy tool, using both a CPI and a core PC metric for the inflation adjusting metric. So it kind of gives two different estimates in that regard compared to the Q1. And this is only showing the Q1 right here because we haven't really gotten a whole lot of data for this on the monthly basis, but technically I could switch it over to the monthly level to show that. But I think all of it's still in Q1, so I don't even have an estimate for Q2 yet myself, right? Yeah, all March data still. So there's nothing really necessarily for me to say in terms of my own nowcasting for Q2 per se, other than to point out maybe that the actual GDP came in at like 1.99, and my two estimates were kind of on either side of that. So pretty decent estimate, I guess you could say. But yeah, so other things to obviously this is not related specifically and directly to energy, but the labor market is really like the big thing that drives whether or not GDP drops are actually recessionary or not. At the end of the day, like at the end of the day, it's not really about the GDP growth numbers so much as it is about whether or not the lack of growth causes unemployment. That's really kind of the reason why it matters about recessions. So continued claims unemployment and continued claims as a percentage of the labor force being kind of the way I tend to look at this on our short-term basis, because they release this data every week. And the truth is this has been improving ever since November. That's the thing, is like this has been actually falling consistently since November. So this is a sign that the labor market is actually less stressed when this number goes down. We had this kind of like trending upward since 2022, which a big bulk of that trend was in the back half of 2022 and the first half of 2023, and then we kind of had like a slower trend upward since mid 2024 throughout 2025. But then ever since November, it's trended back down to the levels it was at kind of mid 2024. So and it's worth noting that when looking at this kind of metric historically, if you're going into recession, that is not how the metric behaves at all. The metric, like once it starts to go up, this metric tends to just go up, with very, very few counter examples. The only real counter example of it really going up and then not, and then kind of just leveling off, I would say, is maybe here you can see 1985, it did a little bit of this upward move that didn't really result in an actual parabolic upward movement into a recession, and then it just drifted downward kind of out of nowhere. And then here you can see there's this quick little spike up in 2005 that it had before then it kind of quickly dissipated back down. But yeah, so like I said, this is that pre-COVID way of looking at it. Here's post-COVID. But yeah, so it's this looks a lot to me like normalization, and also this relates into, like I said, this will be a good warning sign for when if energy shocks are actually causing true economic damage. This would be a warning sign. But this relates back to a lot of the private credit worries that people were worried about prior to the energy shock hitting as well, because that was obviously a huge discussion that people were going on and on and on about. And this was definitely one of those things I constantly looked at to be like, hey, I don't see the concerns yet. It's private credit, you're worried about software, you're worried about layoffs. It's like all this, it's all future worries that is not showing up in the data yet. It's like people are saying that the AI of this, AI that's, productivity this, productivity that. At the end of the day, and people, job openings this, job openings that, youth unemployment this, youth unemployment that. All the different arguments people have been made, and some of them are more valid than others. It's worth noting. I'm not trying to belittle anybody who personally feels like maybe they've had a hard time in the labor market, but the point is it's basically anecdotal at this stage. It's not truly at a serious level until these kind of metrics change around. That's the birth of it. And on the subject of private credit, did want to look at like delinquencies as well. Now this is delinquencies with commercial banks. It's worth noting, not with private credit, but at the same time, if these things are going to go simultaneously. It's not going to magically have a huge rise in delinquencies in private credit funded companies and then just not having no real rise in delinquencies in the commercial bank loans. Like they may be different in scale, but they are going to correlate. Like there would be zero reason that they wouldn't correlate. So like within that, I have delinquency rates here separated out by all sorts of different categories. So all business loans, specific subcategories of loans. We have lease financing receivables, real estate loans, and then consumer. We have credit card loans as well as other consumer loans, which that includes a decent amount of student loans, and then we have single family residential mortgages. So like these are kind of all separate categories within that. And let's zoom in kind of here at this. And I mean, some of them are going down, others are maybe still going up but are not at super high levels. Again, kind of zooming back to that like long run here, some of them are well below kind of longer term averages. And then I actually have took all these rates and have a different chart that shows them all on a year-over-year basis, because as I kind of mentioned before, it's like a good way to kind of sanity check yourself when you're looking at a chart like this, and you're seeing like there's an interesting pattern going into recessions, and you think that maybe in the short run you're seeing that same pattern developing here in the short run. Like that's not really what I'm seeing here, but the point is you would have thought that back here in like 2022 and 23 when they were starting to rise up here, people would have seen this and been like, oh man, are we going into recession? This is a big worry thing here in 2022 23. I say here, like once you see the leveling off, then that's when I'd be like, oh, okay. But on a year-over-year basis, how does that same thing look? And you can see there was some of them that were definitely starting to rise to a high level, but then they did start to heavily recede. Some of the weaker ones, those commercial real estate loans did get up there for a little while, but look at how much that year-over-year basis has come down on those commercial real estate loans. Pretty good. Other ones that I would say are maybe kind of the more worrying signs. Credit card loans were kind of spiking there a little bit, but they've actually come down on the year-over-year basis again. Like if you're looking at the overall levels, it's the more stable looking generally. But anyway, the point being is, not really seeing huge stress in credit. Not really seeing dramatic stress in that regard. So anyway, that's my kind of like quick little run. I say it was like 30 minutes little run on economic data, the energy shock that I would say we're not really super experiencing yet, but we're maybe potentially slow rolling into, and so that's kind of how I'm thinking about it. Is like this is me showing the data you can watch on kind of a daily, weekly, monthly, quarterly, depending on which of these you're looking at. Like all these come out at different periods, but lots of data that you can look at to kind of check what's going on in your mind a little bit. So let's talk a little bit about some company earnings. We have had some of our favorite companies report, or let's chat a little bit, I guess, about the portfolio, I guess, a little bit first. We'll show that I did kind of hop in, talk about some other stuff. So here's the portfolio as it is as of Friday. Nothing super major to say about this. Going into FG's earnings, I was buying some more FG, like literally like in this last week or so. So we'll be talking about FG here shortly, but spoiler alert, they did drop on earnings. They did bounce back pretty strongly today. So that's bad news and then good news. But like I said, we'll talk about that in a minute. But yeah, so did add to that. Haven't added to a ton of other positions in the kind of short to medium term, other than kind of like my macro and rotational strategy. Pretty interesting to watch on some of that in regards to the macro strategy. I know I've talked a few times about the South Korea ETF that it had popped me into early December, I think it was, when it was pushing me into that. But pretty crazy, because I'm actually now up over 100% on a weighted basis across that investment there, which is pretty crazy, because as I know I've mentioned several times, this strategy isn't really specifically designed for getting massive gains so much as it is about getting relatively high confidence gains in a very, very short period of time. But I have also said that part of the point of the strategy is to attempt to try to catch some good medium term trends in certain markets relatively early in the trend, even if that means you're not grabbing sort of an actual bottom on it, because it is a momentum based strategy. So that's, I guess, what I would say is like, describing it both of those ways in many ways kind of works contrary to each other, because one of them basically argues that it's super short term and the other one argues that it's sort of more of a medium term strategy. And the truth is it's kind of a little bit of both. So pretty crazy to see how that worked out. 107, 108% on South Korea ETF in like half a year worth of time, which is pretty crazy. Very, very small portion of the portfolio. Obviously it's not massive. Even after that doubling, it's only at 1% of the portfolio. But hey, whatever. That's 0.5% of house money, right? That we'll call that right there. So very, very cool. Pretty good gains on Taiwan as well right now. And then tech and energy ETFs, which shouldn't be too surprising. But then in the individual holdings, I mean, there hasn't been a whole lot of change over in the short term. I've bought small positions in some kind of speculative small plays that I'm kind of like dabbling in a little bit. And then outside of that, I've been adding to other plays like Uber a little bit here and there. I know I've talked about Uber a bunch in the last handful of months about the fact that I'm interested in them, and I haven't added to them a lot, but I am still keeping very much an eye on them. And I mention them now because they did also kind of have not a super great earnings report, which in some ways I was sort of expecting. That wasn't expecting a great earnings report from them this particular quarter, but they still reported various metrics related to the expansion of their kind of like overall platform that definitely makes me still feel pretty good about them in the long run. So I definitely think Uber is a potentially very interesting company to look at for the long run. They very much could be a very, very strong story stock for the next several years. I know I haven't done like a full dedicated video on them. I know I've just kind of talked at various points on stream about them, but that's where I'm at on that. And then Generac is the earnings we're going to talk about here next. But yeah, they're still at 7.2% of the portfolio. We did trim down a little bit on them when they had hit some pretty high levels previously back here in February. I know I had trimmed a little bit of them, and that was after I had added to them back here in December. And then I think I trimmed a little bit of them, or no, I didn't trim. I trimmed a little bit of them here, but then I added a small little bit of them here in March, but before these earnings, because I definitely had a good feeling about this earnings report, which is I didn't necessarily think that we were going to get this kind of price action, which is pretty cool. So we're now up at almost 270, which is pretty crazy. Because in my mind for a long time here, having originally been buying them around $100, and I bought below $100 a handful of times, bought above $100 a handful of times, and then in my mind it kept going up kind of close to 200 a few times there. So this kind of like $100 to $200 range was definitely kind of like somewhat of an anchor in my mind there for some time, because it had just been there for a while. And then we had started getting up to this 200 level, and so I kind of accepted that we were going over 200 here for the last like several months, like a year or so. But in my mind I was kind of thinking of that as sort of like the peak. So like if it got over 200, I was like, well, that's definitely like really overvalued and whatnot. But yeah, now we're closer to 300 than we are to 200, which is just how fast that can happen. And I mean, obviously numbers compound, so that's just how that works. But in that regard, looking at the performance, they only just barely beat the estimate for revenues, but significantly beat the estimate for earnings. So there was a pretty strong beat on that regard. And coming over to uh, their report. Very, very strong sales in commercial industrial, which is where their data center generators are, but increased approximately 28% compared to the same quarter a year ago, which is pretty crazy. 28% compared to 1%, for example, in the residential segment of growth, which, yeah, because their residential segment has definitely been struggling the last couple of years, what with the massive slowdown in home sales, because they are definitely much of a follow-on kind of purchase to home sales. So there's a huge link in the chain there. And once we get like home building really start to pick up, that's when you would expect to see the residential portion of their segment start to pick up. And that's why it's been honestly such a huge boon to their business that the AI data centers have suddenly decided that they have a massive need for this type of backup power generation, because it really created a counter-cyclical kind of a buoy to their growth rates, where we're getting this kind of growth. And I know I commented on the CEO a quarter ago, or maybe it was 2 quarters ago, commenting that he believed that the C&I business could eventually become a bigger portion of their business than the residential. And it's like, well, I mean, look at this, 510 million in this quarter compared to 549 million for the residential. So it's literally almost the same amount in this quarter. Now that's just Q1. We'll see when we get a trailing 12 month that looks like that, because this could have been, like I said, this could have been just a really weak residential quarter matched up with a really strong C&I quarter. And so it could be that, for example, maybe there's like slightly less revenue next quarter in C&I, maybe even like maybe there's literally even a pullback slightly, while residential maybe has a stronger quarter. Hard to say. We don't know. We'll find out in that regard. But yeah, so very strong here in this first quarter. And like on some of the comments he says here, or even before that, updating the full year 2026 net sales guidance to be mid to high teens, and where previously it was mid-teens. I think they had said previously. Oh yeah, it says right here, previous guidance, mid-teens percent. So mid to high teens is now what we're getting there, which if you say mid-teens, that kind of implies 15%. You say mid to high teens, it kind of implies 17 to 18%, right? Just kind of vaguely, but the comments here: first quarter results, significant growth in C&I, strong adjusted EBITDA margin expansion, as well continue to strategically create a more balanced business with improved scale, says Jagfield, which is the president and CEO, who we love. Continuing to build momentum in the large, rapidly growing data center end market, as we are in the final stages of vendor approval with multiple hyperscale customers, and have expanded our backlog for these products with both new and existing customers. So very important sentence there. That's awesome. Final stages of vendor approval with multiple hyperscale customers. So very cool in that regard, because they had the big backlog with their hyperscale customers already, but we didn't really know which hyperscale customers, how many of them. There's a handful of these hyperscaler customers out there, right? So if they're potentially getting multiple new ones, we probably only had a couple previously. So if you're getting multiple new ones, it means you might be basically doubling your hyperscaler customer base, or at least 50% increasing it, right? And then they say they're expanded the backlog here. It's worth noting that they didn't really give a number on that. I think the number they gave last quarter was like 700 million or something like that. So that'd be, maybe it's 800 million or now, I don't know. They didn't give us a number, but either way, you can kind of compare that with the 500 million quarterly number we were getting for the revenues, right? So if 500 million is the quarterly number, that means if you analyze that gets you to like 2 billion in C&I revenues for a year, which means that for C&I specifically, your backlog is basically like like 25 to 40%, depending on kind of how, like I said, if you do 500 or if you do like the full 510 annualized, and depending on kind of what you assume, like a 700 to 800 or for the backlog there. Very strong backlog in terms of like for the C&I specific segment. Now, in terms of like the total revenues, it's a smaller portion, because like if it's like 5 billion to 6 billion in total revenues, well then a backlog of like 700 to 800, and it's like that's more like 15 to 20%, right? So, growing the backlog, but that backlog is still growing fast. I wish they'd given a number in this quarter, but no specific number in that regard. But still very good to see. Also completed some small acquisitions further increases the vertical integration. They definitely have been doing small amounts of acquisitions on all sorts of stuff. And this specific one, the Incineron company they bought is supposed to help with margin expansion specifically for the large megawatt backup power solutions. So it's kind of like increasing the product environment ability within the C&I segment, because they'd really done a lot of focus in terms of their acquisitions towards building that kind of like home ecosystem for their power products, for the residential products, but they're kind of trying to do a little bit more of that for the C&I products, which is good. So let's come down here to look at some of the actual financials. So the income statement here for the quarter, 940 net sales in Q1 last year versus 1.06 for this Q here. So strong growth in that. Gross profit, you see, going from 372 to 410. So a little bit more, even more growth in that regard. So it's a little bit of a leverage effect on the unit costs level, and then even more operating leverage from the operating expenses level we get right here. Very, very strong in that regard, with a little bit lower selling expenses, basically the same, and research and development expenses, a little bit more in G&A expenses, and a little bit more in amortization expenses, but significantly less relative to the growth and the gross profit there. So you get going from 84 million in income from operations up to 117 million. So very, very strong. And then likewise, that kind of funnels through all the way to the net income to the shareholders. Very, very strong growth and profitability. Their profitability does bounce around quite a lot, though, is worth noting. So that's definitely just an aspect of that. Cash from operations more than doubled. But again, lots of bounce around in that regard. Cash flows, kind of likewise, basically. So yeah, very, very happy with the Generac results. Probably gonna maybe have to consider, I mean, it's one of those things where it's like on valuation alone, it's tough. It's tough because like they have, like I've said it before, they have really one of the best stories that kind of like, for me anyway, from my perspective, it's a story that I have good confidence in their fundamentals for a very, very good period, and then those fundamentals are balanced out between those segments, which I really like, and then the fundamentals are based down to kind of like a level where it relates back to a lot of macro data that I understand as well. So I have a lot of confidence in the story around Generac, and I have a lot of confidence in the CEO. So it's one of those things where it's like, it sucks like seeing it so overvalued, because like I don't really want to lower my allocation to the company, but it does, if the returns aren't there, the returns aren't there. So I have already updated the valuation here in the dashboard. So I do have it as like 24% overvalued with expected returns of like almost 10% or so currently. And I do have a very high allocation target still for the company. But a lot of that is based on the fact that it is running on very high momentum. So like once that momentum would turn around, it would pull the target size down. So basically that's like how in my allocation system, I basically let the stock run on current gains as best to my ability as I can. So that's basically what we're doing with the allocation right now. But like, yeah, if we get a little bit of a curl back here, I probably will quickly try to trim out of some of that position, and who knows, maybe add to it if it goes back down even more. But it's worth knowing that, yeah, like if you kind of like look at the trend we've had for like the last year or two, it very often gets a pop on earnings and then kind of drags down for the next like several months before you get to the next earnings. And then often there is a pop on earnings, not every time, there's not great reactions sometimes, but there is often pops on earnings, but then kind of a little bit of a drag afterwards. So yeah, we'll see what happens this next week. This first week here after earnings has been kind of a little bit of a surprise that it's continued upward nicely like that. But yeah, we'll see what happens with that going forward. All right, so let's turn our attention to FG. It'll be the last topic for today. Hopefully a meaty topic. Getting hungry. Definitely need some dinner. Hopefully I have enough energy to carry through to the FG discussion. So FG reported. We'll start with looking at the chart. After you reported, before it reported, let's talk about what before it reported. I think it was basically roughly here, March like 12th or something, roughly in this range right here. They made their announcement for the new buyback program, which was a kind of a nice surprise. It was very much a surprise for me, considering the actions they had taken over the last year of raising capital and moving the capital ownership structure around with the F&F ownership in so many different ways. I felt confident they didn't really need more capital, but the point is it kind of was what you would describe as not very shareholder friendly actions, right? At least to your common shareholders, right? It was not very common shareholder friendly actions taken last year, which is one of the reasons the stock performed so poorly, is the shareholders were like bet on that. So the point is, like, the buyback announcement was somewhat of a surprise, but at the same time maybe it shouldn't have been too much of a surprise, considering the press price was so extreme. And I know I talked about this last time we streamed. I know I talked about this, was that I had already gone back through and kind of like reanalyzed the previous buyback program that they had announced, which they had announced back here when the price had previously collapsed, and that was during the SVB banking mini crisis we had. But the point is, like, I didn't really pay too much attention to it because they didn't use too much of it, and also it was not soon after they had gone public. So in my mind, it was partially like something where you could have easily just seen that as then putting a buyback program in place, just so that there was a buyback program in place, because you have to get the board approved. So oftentimes companies do just like to get one in place ahead of time, even if they're not going to use it that much. Which, like I said, we didn't see too much usage of it, but maybe they didn't use it too much is because they were actually expecting prices to kind of maybe go lower in that crisis, and then that didn't really happen. And then eventually it went on to a huge bull run. So the small amount of purchases that they did do in here, I believe it was, kind of maybe just indicated that, well, that was that, and then we were going to be very disciplined about it. And so, like I said, that was what I had said last stream, was that, like, after reanalyzing that situation, it kind of made me feel that maybe they were just being very disciplined about it. And so I had said back here when they made the new program, I was like, well, maybe there's some reason to believe that they will actually seriously try to use the program this time, because they do have depressed prices. So unless the price goes up dramatically, we'll see. And it was worth noting that the CEO was commenting on the depressed valuation multiple times over the last few quarters at various points. And he'd also been putting his money where his mouth was in terms of personal purchases on that regard as well. So there was a lot of reasons to believe that maybe they were serious about the buyback. Then they had put in place, I think it was like here, I think that was actually what caused this little pop here, is they had put an announcement out that said that they were putting a program in place with an outside brokerage, so that the buyback program would go on autopilot due to certain circumstances. Basically, they would say, like, if it was under this price and if volumes were behaving in so and so way, then we want you, the brokerage, to go and do a buyback program for us. So they're third partying their buyback program, which is not uncommon. That is very, very common actually for public companies. But the point is, companies don't always make an announcement and a release about this. But the point is, they did this because they were entering the blackout period pre-earnings, and so it seemed that they wanted to be sure that they could continue to do the buyback legally during the blackout period. And so I had commented on that in the Discord, said that, hey, that seems to be a good sign that they might be serious as well. But at the same time, in my head, I was like, well, we'll find out. We'll see what happens with that. And then also, after that announcement, you can see what happened with the stock. The stock just climbed like a rocket right into earnings. And so in my head, I was kind of thinking about that. I was like, okay, very cool that the stock is going up as fast as all this. But that actually means that I now have no idea how much of the buyback they may be using, because who knows? I don't know where that price limit was set, like I said, by the program. Like, for all I know, they said they only wanted to buy below $25 per share, right? I don't know. It could have been below $30 a share. I have no idea. So I was like, well, cool that the price is going up, but now I have no idea how much capital was actually returned to shareholders, which on one hand, that's fine. It's fine if the stock goes up without that. But I had also commented to a few people privately about this, that it was kind of worrying to see this going into earnings, because in my head, I was like, well, either somebody knows something or somebody is speculating on something. And then that means maybe you're setting up for a failure there. So that's the foreground for the last couple weeks of my thinking going into the earnings here. And well, lo and behold, we did probably get like a speculative kind of sell the news event, I think, on the earnings. And also the earnings themselves were not not amazing, definitely. So that's part of it, is that maybe the speculation did play out the way the speculator expected or something. I don't know. But I do think that a lot of it probably was speculation based on the buyback program. People probably were thinking, oh, okay, well, this much is the EPS is going to change this much because of the buyback program, this. And so there was like some questions about that. And so we'll get to the buyback program, but looking at those earnings first, we did or can we walk over here to the, it shows us, you're looking at the earnings here. Now here it shows the revenue estimate, which here it tends to only show the premium and annuity revenue. It doesn't include the interest revenue. So here it shows the revenue actual of 2.25 billion. It shows it as like a big beat, but really that's not really a big beat. It's actually basically in line on the revenues level. But here in terms of EPS, we did have a miss. We did have a decent miss for that's the adjusted earnings estimate. It's worth noting. So coming back over to that, the adjusted earnings for the quarter, 110 million or 82 cents per share, compared with 72 cents per share for Q1 of 2025. I think, and as we just saw, the estimate was what was it, like $1.06. So, you know, a decent miss there. If $1.06 was if 82 cents is 110 million, then $1.06 would have been like, I don't know, 130 or 150 million or something like that, compared again to with 91 million from Q1 last year. It's worth remembering that Q1 last year was when we had a significant drop in sales, partially because of all of the volatility around the tariff announcements, and we had big spikes both in equity volatility, but also in bond market volatility. And I know I commented on this at various points before. So it was like this huge spike here caused like some issues in their pricing mechanisms, and basically they intentionally stepped away from sales to a higher level in Q1 of 2025 because they basically were like, let's try to not accidentally take on unprofitable sales just in the name of getting those sales. So it's worth noting that here in Q1 2026, what did we get? A big spike in the move index, not up to the same levels, and it was at a lower level for significant portions of Q1. So it's worth noting that like that's still I don't think it affected in the same level, and not to the point where they didn't comment on it in the transcript, where they did comment on it in Q1 of 2025. But it is worth noting that this almost certainly still had some impact on that to a certain extent. And then on kind of like to a larger note on that front, more things that I did not pull up prior to starting the stream. But we did get the preliminary estimates for the annuity numbers market wide. And it's worth noting that Q1 was just a generally weaker quarter for the annuity numbers. Here we have $105 billion for Q1 versus 117 billion for Q4, and Q1 2025 was 107 billion. So it's weaker than even Q1 2025. And the issues with those pricing dynamics would have been industry wide. It wouldn't have been just an FG thing, right? So it's worth noting that. So a weak Q1, definitely just kind of industry wide. Fixed index annuities, specifically, also kind of particularly weak, and that's the big category that it makes up the larger portion of the annuities that FG sales. And then registered index linked annuities is also a category that FG sales, and this is supposed to be like one of the high growth segments of annuities. Also pulled back from Q4 last year. They were still higher than Q1 in 2025, but still, so definitely weak industry wide, I would say, for annuities, which is not actually that surprising. Anybody who's been paying attention to a lot of the stuff I've talked about, just annuities and insurance industry wide dynamics and things that affects the pricing for them, that I've talked about many times over the last like year and a half. One, while we're looking at it, the move index, like I said, is an industry wide dynamic. But I've also talked about the yield curve being something that matters a lot, like where movements in the yield curve to a dramatic degree can be very difficult for them to adjust to in the short term, but the actual high level that it reaches increases profitability for insurance companies, because that spread, basically they get to capture on that spread. Now, this somewhat depends on the type of insurance company you look at, but Generally speaking, this is true for insurance companies, and it is true for FG, generally speaking. So I know I started talking about this a lot actually back here, basically in like the end of 2024, where we did get some climbing out to these some higher levels here, but then it was basically flat for like the most of the back half of 2025, much to my chagrin. And I was actually basically blaming a lot of the weakness in FG's performance partially on this, as well as those kind of capital allocation decisions that were not very shareholder friendly, because this was basically meant that the market could no longer price in further improvements in profitability for FG in the future going forward. And while we hadn't risen to a high level because we're actually pretty low historically speaking for that. So yeah, that's within that. But it's worth noting here, zooming in to Q1, as you can see, we had reached some high levels. We'd finally started to break out to like some peak levels here in Q4 of last year. But then Q1, and especially once the conflict began, it's been giving it all back, right? We're back to where we were in April 2025 for the 10-2 spread. Now looking at the 10-year 3-month spread, which is a little bit of a wider spread even further, this has continued to largely climb to higher levels. So maybe we'll get a big reversal in the 10-2 spread. And it's worth noting like the 10-3 spread is a more comprehensive spread for the whole range. The 10-year to 3-month spread is more complete in terms of the full like duration of the curve. But the 10-2 spread more accurately represents like what real borrowers can do, because most borrowers can't borrow on the ultra short-term market and actually make something super useful out of that, other than just basically like very, very short-term working capital uses. So the point is like for the insurance company discussion, really the 10-2 spread is the one that's going to be the most important. The 10-year 3-month spread just might give you a better idea of like that the 10-2 spread will eventually turn around. It's just that this is short-term dynamics. It's basically saying that in the 3-month to 2-year period, they are reflecting weakness. That's kind of like what that gap kind of implies, is that but over the 3-month to 2-year period, the market is expecting serious economic weakness. And what is that weakness related to? The energy shock, of course, right? That's why that began to flip around in mid-February once people were starting to sniff out that was going to occur. And then it started to go down significantly in March, April, and May. Yeah. So like I said, though, that will eventually close. The gap between those two will eventually close. It'll eventually close when the 2 years, or when the gap between the 10-year and 2-year eventually starts to spike back up, or when the gap between the 10-year and the 3 months starts to spike down. And that will happen either because the Fed decides to hike rates, or because the market will start to price in more growth. Well, it'll be one or the other within that. So anyway, coming back over to FG, big divergence there to talk about like those industry dynamics for the insurance companies, of course, but we can talk still a little bit more about the actual performance of our favorite little company here. Gross sales Q1 3.2 billion versus 2.9 billion. That's not revenues, that's sales. Then the net sales, which is after it accounts for the portion of the capital that they sent off to reinsurance, 2.2 for Q1 last year versus 2.2 this year. So they kind of kept it flat after adjusting for reinsurance, basically. Assets under management grew 54.5 to 56.4 billion right here. Oh, that's compared to last year. I was about to say, I was like, wait a minute, that doesn't sound right. I'm thinking of compared to last quarter. I'll get to that in a moment. Average assets under management still grew from last year. Assets under management after reinsurance grew from last year. So that's what we like to see. Adjusted return on assets has grown since last year, but still kind of at weaker levels. We want to get this number we're hoping to get this number in the long run above 1%. Really, that's what we're aiming for, is getting this number to up above 1%. And we really want to get this number up above 10% for sure in the ideally the very near term. And then in the long run, we'd like to get it even to 15% if we could, but that could take some time. So yeah, net earnings. Again, we were just talking about the adjusted net earnings. and I know I've commented many times in the past that I think that the adjustments that the FG does is generally pretty good. I don't have huge quibbles with their adjustments. It may not be perfectly exactly the way I would have adjusted their earnings if I wanted to do an adjusted earnings, but it's, you know, some companies do horrible adjustments to their earnings and some companies do okay adjustments to earnings. And FG's is definitely more on the okay end of the spectrum. But I will say, for the last like several months, as I've been kind of like analyzing lots of company data in between different industries and stuff, I've kind of like come back around to a, you know what, never mind, I just want to use GAAP earnings kind of attitude about a lot of things. And like I said, that's partially because I've been looking at lots of company data between different industries and stuff. And so like when I'm doing that, I end up like in this attitude where I'm like, you know what, screw all these adjusted earnings, just give me GAAP earnings so that I know it's by the same rules that I know, you know, and not like all these different rules for all these different companies. It's like, I want to know whether or not the stock-based comp is in there or not, right? Like, I just want to know if it's in there already or not. And I want to know whether or not you have your amortizations left in. I want to know whether or not you've left your merger expenses in. And I want to know whether or not you've left, you know, whatever it is, you know, all of those different things. And so, so while, like I said, like I don't have a huge problem with the adjusted earnings here, I've sort of been just focusing a lot more on the GAAP earnings for all companies lately. So within that, we did have a GAAP loss last quarter, and we do have a nice strong GAAP earnings win this quarter. It is worth noting that they're saying their adjusted earnings is lower than the GAAP earnings. So, you know, it's always worth noting when that's the case. But like I said, there's plenty of other quarters where they say the adjusted earnings is higher than the GAAP earnings. So it's like, again, I'm focusing on GAAP earnings, but I'm focusing on GAAP earnings over the long run, not one specific quarter of GAAP earnings. So yeah, whole lot of winded caveats to that. Let's come down here to some of the actual kind of more detailed finances. Don't need to really look at the balance sheet too much other than to maybe look a little bit here at the equity portion. We did have a growth in retained earnings, which is good, even though we paid out our dividend, and then also we did our buybacks. So here you see a big increase in the buybacks. We went from 40 million in net held treasury stock, which is basically the total amount of buybacks the company has done that had where they haven't canceled the shares, because the company can do a buyback and they can get rid of the shares permanently, or they can just hold them on their balance sheet, and then theoretically they could reissue them to the market without having to do anything with that. Most companies don't, but the point is you could theoretically if you wanted to. But anyway, the point is, like, here 40 million, it's up to 60 million now. So that is a decrease to the book value. It's like when you do a buyback or when you pay a dividend, whenever you return capital to shareholders, that's a decrease to the book value because you're paying out the earnings. Book value is accumulated earnings, right? And so like that's how that works. And so, and then we've commented on this many times before. They have this AOCI, accumulated other comprehensive income, which the majority of this is basically temporary losses on their bond portfolio due to the prices being lower because interest rates went up. Some of it is some other stuff in there as well. But basically in the long run, this basically tends towards zero. Like it might be at like negative 1.8 billion right here, and it's actually higher than it was a year ago. But it's basically mostly short to medium term stuff. There tends to be a lot of short to medium stuff added onto there, which is why you can see it grow like this year over year. And the reason why it grew in this particular year, by the way, is mostly because of them doing the what's it called? The divestiture from the Bermuda life reinsurance that they did here in the last quarter. So that's actually the reason why I did that here right now, by the way. But the point is, in the long run, this tends towards zero. So I don't really focus too much on this. I just want to see retained earnings growing. It's like we want to see retained earnings growing, and ideally we want to see the common equity number growing. So here you can see the common equity number did shrink over the last year, but considering, like I said, it's mostly due to them doing that divestiture, and also them more than doubling their shareholder return in the last quarter. I'm okay with that. That's okay. That's fine. So that's fine. Coming down to the income statement here, we kind of already talked a little bit about the revenues, but here you can see premiums relatively flat, a little bit lower than they were last year. Interest income a little bit higher than it was a year ago, which has to do partially with those spreads being higher, like I was talking about. Own distributions is only slightly higher because they didn't do any further investments into that in the last couple quarters, which is fine. And then the recognized gains, they still have loss for both these quarters, but much lower of a loss because the tariff volatility it created a big loss last year in that regard. So the expenses, benefits, a little bit lower, market risk lower, depreciation a little bit higher, personnel costs a little bit lower, other expenses a little bit lower, interest expense basically flat. So very, very good expense control, lower overall benefits and expenses. So that's partially like where that bump in profitability basically came from in this quarter. So yeah, kind of a weak quarter in terms of revenue growth. We didn't get the revenue growth that we might have wanted in terms of, but like I said, that's partially industry wide. So it's like, okay, whatever, we'll wait on that. And like I've kind of talked about those macro factors that are kind of playing into that. But the expense control, I think they did a very good job this quarter. I think the expense control was very good. So the profitability improvement was very, very strong. And so like, I know they didn't hit the expected number for earnings, but as far as I'm concerned, it seems like maybe the expected number was just a little too bullish, honestly, because like the improvement in profitability was solid. It's solid. There's no doubt about it. Now, like I said, it is very volatile quarter to quarter for that profitability. So really what I want to see is like 3, 4, 5 quarters of improved profitability, not just like 1 or 2, but still. So yeah, I'll come down here to some of these other factors. Here shows kind of the assets under management change, the flow, and this kind of relates back to also the book value thing I was talking about here. So assets under management at the beginning of period, they add the net new business assets, which is positive, less net new business assets than it was last quarter or the quarter before that or the quarter before that. So it's kind of a little bit of a weak quarter in terms of net new business assets, but it's still positive. As long as this number remains positive, it's good to go. Like we're not worried really about the business when this number is positive. And they've had weaker quarters before. Like it doesn't show up for these 4 right here, but they've had weaker quarters. And then down here, the flow to reinsurance, as I've kind of shown before. And this is kind of the thing about the reinsurance is nice because it means like if they have a really, really weak quarter revenues wise, or I should say sales wise, then what they can do is they can just send less of it to the reinsurance, and that allows them to keep a larger accumulated increase to their AUMs even when they have weaker quarters. Which is why when they've had some of these weaker quarters before, you'll notice that like we're almost never talking about the AUMs not growing. Like the AUMs are kind of just chugging along and growing even when they have these weaker sales quarters. And that's how they do that, is because they have this lever with the reinsurance where they can basically decide to send more of it to them or send less of it to them, and that allows them to kind of buffer a weaker sales quarter. So it's which is one of the nice levers that this business model basically has for them. So also here you can see the net enforced reinsurance to third parties has a big decrease here, and this is that with the divestiture from the Bermuda business, they also then added them as a reinsurance partner and then ceded a chunk of business to them, and so that caused, as you can see here, an actual decrease in the AUMs in this quarter. So in this quarter, the AUMs at the end of last quarter and the AUMs at the end of this quarter are actually lower for the first time in some time. Like I said, that we don't see that a lot, but it's basically because of that reinsurance ceding. So not too concerned about that. And also because they did that, like I said, that basically increases the range of that flexibility in the future. So it's like sacrifice a small amount of AUMs in the short term to have the flexibility to make sure they can grow their AUMs during a bad quarter in the future is basically kind of what that gives them. And also you can see the average assets under management year to date is still growing, which is where that kind of like annual investment income total is going to end up coming from. So focusing in on the sales highlights here, the index annuities, FIAs, and the RILA, which, like I said before, is kind of like the meat of their sales for the most part, is better than it was in the quarter last year. IULs, which is that fast growing but small portion of their business, grew, but very, very weak growth. Pension risk transfers was basically flat as with what it was last year. So a little bit of growth in their core sales, but most of that growth kind of just came from the FIA, and that's worth noting. Again, they had the weak quarter last year in the same quarter, so it's not really that impressive to have this much growth on the sales compared to last year's quarter, because really we were hoping to get a little bit stronger growth in the core sales. But again, those somewhat macro factors that were hitting us in this quarter in somewhat of similar ways that they were hitting us last quarter. So coming down here to the more opportunistic portion of their sales, they have the MYGA annuities, which you can see we had a much weaker quarter compared to the same quarter last year. But then that's kind of balanced out with actually a much stronger funding agreements quarter here, which is institutional portion of the opportunistic business, which in my opinion is much better than the MIGAs anyway. So overall, opportunistic was still stronger, which means overall gross sales still stronger. And then, you know, they still had that reinsurance lever. They kept the overall net level basically flat, as you can see here within that. So, so yeah, as I said before, kind of not the strongest quarter sales wise. It wasn't a strong quarter industry wide for the annuities. We haven't seen really the industry numbers for pension risk transfers yet, which I look forward to seeing. But nonetheless, I think they, like I said, the expense management portion of what they did this quarter, I was more impressed with. They still didn't, like I said, hit the analyst estimate on earnings, but that's the analyst's faults, I guess, in my opinion, because it was still a very solid improvement in profitability. So it just seems to me like the analysts were maybe overshooting that profitability gain, but they were probably also expecting stronger sales too. So they probably expected some of that increased profitability to come straight from the sales, flowing straight through to the bottom line. But anyway, taking kind of like those overall changes all together, book values, the overall book value per common share, you can see coming back from the June quarter 2025, $31 per share, $33 to $34 per share in September, $33.50 or so in December. So you can see we did have a little bit of a shorter decrease there, which was kind of explained by some of those changes in capital dynamics. And then back here in this quarter, also a little bit lower, but again, explainable partially by changing the capital dynamics, specifically in this quarter, the seeding of the Bermuda portion of the business, as I was just talking about a few minutes ago. But book value excluding the accumulated other comprehensive income, as I've talked about before, which is basically kind of like a lot of market gains and losses listed into the book value that slowly should tend towards zero over time. We saw a big bump up in this quarter due to them seeding the Bermuda portion of their business. So that's part of the reason that that caused not an increase in the overall common book value. But if you exclude the AOC, which they often do like to show us this figure every single quarter, you can see that still did grow from 44.43 last quarter to 46.51 in this quarter, showing that. So yeah, like the overall general trend, because like that's what it is. It's like the book value per common share here shows you like what the actual book value to the common shareholder currently is, but this shows you kind of what in the long run where that book value is based off of the actual assets of their business. Like once you kind of just accounted for the short to medium term fluctuations, this is like what the real assets are sort of worth. And so in that regard, you can see it's still growing. The real assets minus the actual annuity liabilities. Anyway, coming down here, is that everything that we want to look at right here? I think it is. I'll come over here to here where my spreadsheet, where I basically have like all the quarterly information that they release. Like it's not even just annual information. I literally have all the quarters of FG's information going back to 2020, basically like when FNF first acquired them before they were even a public company, just like when they were a segment within FNF in 2020. But we have like all quarterly information for them going back for all that to get an idea. And so that's what I mean, like looking at those quarterly fluctoations in profitability on a GAAP basis, there really is quite a lot of variability in that regard. Like if I look here just on the quarterly income statement here, to total revenues, here net income to common, as a percentage of revenue, net income to common, you can see there are like quarters in here that, let's see, what's the peak quarter? 37%, it looks like, or 31%. 31% is the peak net income quarters that we got for a few quarters in 2021, versus the lowest we see here is negative 22% is the lowest I'm seeing here. So yeah, huge variability quarter to quarter in the profitability for FG. But then if you look over here, I have the average over that same time frame and the median, and it ends up being like 10 to 11 or so. Or actually, is it for the whole thing, or did I okay, it is for the whole thing. I thought maybe I cut it off at like once they were a public company or something like that, but I didn't do that in this particular case. So the point is that a lot of variability quarter to quarter. This particular quarter, it was 21% of a net income margin, but the quarter before that, it was 7%. The quarter before that, it was 7%. It was 3% before that. It was negative 3% before that. It was 17% before that. So it's like it bounces around, but it's about 10 to 11% seems to be sort of the net income profitability that we've seen historically. And then also I know like I built my newer model. Well, I don't know if I want to pull that up right now, but I'm pretty sure my the model that I showed, I think last show I did, or maybe it was a show before that, where I was showing my more comprehensive 3-statement model for FG that I've built more recently in the last handful of months. And I think the kind of like long-term profitability I arrived at in that model was more of even like just like an 8% or something. So even in that, which is what my valuation ends up being based on. In fact, actually, let me go there. That's probably the fastest way to look at it. It's like what did I actually put in my valuation? Yeah, 8%. 8% was basically kind of what I'm putting in as sort of the a long-term sustainable margin for FG. But because that 3-statement comprehensive model, I'm taking into account some longer-term annuity obligations and stuff, and trying to really kind of take into account like a very long-term cross-cycle. What is the real profitability of the company there? So like I said, a lot of differences within that and with the here. So seeing 10 to 11% historically, that just shows you that in the short to medium term, they're actually more profitable, which means that they get the profits up front first, which means they get to invest those profits. And then that kind of buoys that kind of lower profitability in the long run. But anyway, coming down here, looking, like I said, this is the income statement kind of up here. 10 to 11% for the income. I'll say within some of the subcategories here, the yields on the interest and dividend yield on assets under management was 5% or so in the most recent quarter versus 4.5% or so is kind of those longer term averages I have here. The yield on assets under management for the premiums portion of the revenues, I have just under 5%. Like 4.5% to 5% or so, and it was like 3.3% in this quarter. So you can see weaker premiums, but stronger interest revenue for this particular quarter overall. And then that revenue is a 28% growth compared to the same quarter last year. Coming down here to the trailing 12 months of the same information, compared to the same quarter last year, trailing 12 months, it's a 4%, or no, it's compared to last quarter, 4% increase, and it's a 9% increase compared to the same quarter last year. And then on that trailing 12 months net income margin, this shows you what I was talking about, where it's like you had 21% for just that quarter, but on the last 12 months, it's about 9% or so. And then like looking at the trailing 12 months, the long-term average, I get 8 to 9.5 or so. So you can see like how once you kind of filter down towards a more stable number, it gets closer to like those estimates I get in the long run. Coming down here to looking at the gross sales, you can see gross sales grew 9% compared to the same quarter last year just for the quarter, and 3% on a net sales basis. For the trailing 12 months, looking at those, the sales on a year-over-year basis for gross, it's only 2%, and for net, it's actually down 3% or so. So it's like I said, like on a net basis, they kind of been really kind of keeping things flat depending on like how you estimate these things. And then the AUMs, the percentage that they're retaining is now down to 76%, which has been trending downward generally. I know I had shown that on a graph over here where you can see like as they grow, the total AUMs, including what they've sent to the reinsurance, and then here shows the AUMs after they've accounted for what they've sent to reinsurance, and here's the ratio. So you can see like over time, the amount they're sending to reinsurance, or the proportion they're sending to reinsurance, is actually just been going up and up and up, which basically means that they are not even taking full advantage of all of the sales that they're actually having, and B, it gives them that lever to in the future make sure that they still capture those sales by essentially reversing that percentage to a certain extent. So continuing that trend. In fact, it accelerated in this recent quarter because of the seeding of the Bermuda life portion of their business. So very, very, very good to see. Coming down here, I have the GAAP return on assets annualized and trailing 12 months, and then the adjusted return on assets annualized and trailing 12 months, and then also the adjusted return on equity annualized, and then the adjusted return on equity trailing 12 months. So here, and then you can kind of compare that to, again, those long-term averages and the median. And so for a GAAP return on assets annualized in the quarter, we've had about kind of like 75 basis points is kind of like what we've had since, like I said, since they were acquired by F&F. And in the most recent quarter, it was 1.73. So it was actually very, very strong return on assets on a GAAP basis within the quarter. As we saw before, the GAAP earnings was significantly stronger than the adjusted earnings. And so if you look at the adjusted earnings, it was actually more like 80 basis points, which is more in line with what our kind of longer term average. And the longer term average is actually closer to like 90 basis points. So it's actually kind of weak, you would say, in some regards. But then on a trailing 12-month basis, which kind of takes out some of that quarter to quarter fuzziness, we have 92 basis points on a GAAP basis compared to like 50 to 60 basis points historically. And then on the adjusted basis, it's still 92 basis points, which is interesting, compared to like 85 to 90. So on a trailing 12-month basis, what I would say is that it actually sort of looks like profitability is increasing. But in this quarter, in the 3-month quarter, like I said, on a GAAP basis, it was good, but on a adjusted basis, not so good. So long way to say, like I said before, it does seem like their expense management program, it has been doing well. It does seem like they are really focusing on profitability more than really trying to push the revenue growth over the last, I'd say, like that's kind of been the focus, I think, for the last year and a half. And so really, we're just not going to feel the real benefits of that until that next leg of growth shows up. And that's kind of like the funny catch-22 to that, is that like you're going to feel the expense management oomph once we get the next bump in revenue, because once we get the next bump in revenue, that it's all going to flow straight to profitability. And that's how earnings per share will like then jump pretty quickly. And then also that'll be happening contingent at the same time as they're doing the buyback program, which means that it might grow even faster. And so circling back to the buyback program, within that, I think they commented on it way up here, a few points within that. Here. In the first quarter, we returned 67 million of capital to shareholders through dividends and opportunistic share repurchases. And okay, he didn't say it in this particular paragraph, but he said it might have been somewhere else. But they literally doubled their shareholder return in Q1 of 2026 compared to the shareholder return in Q1 of 2025. And that's nice, but that's only nice if it can continue, right? So it's like, okay, cool. You did the buyback program this quarter. Where does it currently stand? So now that's where it gets to actually understanding that the level of buybacks that they did, they actually only used up basically all of the remaining buyback program from the previous buyback program. So like they had leftover buyback program from 2023, and that's what they used in the most recent quarter. But the 100 million that they had announced a few quarters ago, they didn't even tap into that at all in this quarter. And so if you look at the amount that they used, the 67 million in capital, and you take into account how much of that is dividends, and then you look at the current buyback program that's in place, the 100 million that's still in place, basically that's enough for them to repeat what they did in this quarter for the next 3 quarters, is what that shows me. So essentially, this 67 million capital return in this quarter could turn into 240 to 250 million in total capital shareholder return for 2026. That's possibly what we're going to end up with, which would be like, if you, for example, compare that with the trailing 12-month earnings, the trailing 12-month GAAP net income to common shareholder is 517 million. So that would be like a 50% payout ratio, total shareholder payout ratio, and compare that with, for example, only a quarter ago, that would basically be like 100% of it. And over like the last several quarters, that would basically be like a 60% payout. So that's them paying out a huge portion of their income if they were to do that. Like I said, that's presupposing that they use the 100 million buyback that's still left over basically over the next 3 quarters or so. But that would basically be them basically repeating this quarter again for the next 3 quarters. If they were to do that, but they could. It's totally possible they could. 1, they've demonstrated their willingness to over the last quarter. 2, the share price has not dramatically increased so much past the levels from which they were doing it. Like the period in which they were doing those purchases was between April 9th And when the earnings was announced, or actually my bad, that's we're not accounting for the portion of in April 9th, because that's the portion post earnings. So we're only accounting for what was done here. So we don't know where the limits of where they said they would be willing to do the purchases at. And so yeah, it's very possible that could occur. And the only way that wouldn't occur is if the prices continue to be up at the current level relative to where they were a few months ago. So yeah, we'll see. Like I said, not a great quarter sales wise, but in terms of where we're headed for the next year, I still feel pretty good about FG. And then last but not least, I kind of wish I had spent more time on this in this discussion, but I spent a little bit more time on other things in this than I had previously intended. But we'll come down here in their presentation. I know I had talked last quarter where they had discussed the specific portion of their business that was in private credit. They had finally broken out specifically like the sections that are actually private credit versus the estimates I had talked about previously. And I had previously said that I estimated it was like 15 to 20%. And then they had come forward and shown that it was basically like 15 to 20% of their business. But here in this quarter, they've now given actually even more information on their private credit portion of their portfolio. And some really, really useful information, really useful information that basically confirms why I'm not really worried about these assets at all now. Like basically they gave enough information this quarter that I'm like, cool, thanks, thank you, I'm no longer worried. So here, total portfolio they show here, the investment portfolio, the total investment portfolio diversified 53 billion by reserve assets. And then here they're showing that private origination makes up about 11 billion, which is about 20% of their business. But then they show the subcategories of private origination where they have corporate lending, infrastructure, real estate, consumer lending, commercial, and other. Now it's worth noting that most of the private credit concerns that people have been worried about is related to a specific subsection of private credit, not all of private credit. Most people are not worried about the infrastructure and real estate portions of private credit. They're worried specifically about corporate lending, which you can see makes up 58% of their portion. But even within that, it's actually a subsection, because here it shows again 53% of total portfolio, 21% is total private, but then in total private 58% of that is corporate lending. But then in corporate lending they show that only about 11% of their corporate lending portion of their business is what's called middle market lending, and that is the specific subsection of private credit that people are actually worried about. That's making loans to people that would probably be junk bonds or high yield credits, low profitability, non-public companies. That's this middle market lending, which is only 11% of the 21%, or my bad, 11% of the 58% of the 21% of the $53 billion portfolio. So a very small subsection. Specifically, they show it right here. It's $0.5 billion out of $53 billion, right? So literally like 1%. 1% of their portfolio is in the area that people are like seriously worried about. Which means that they, to wipe out their book equity, to wipe out the company, they would have to take like 20% losses on those loans, which again, I was showing you those delinquency rates earlier. We are not seeing massive delinquency rates particularly. And then also here they did, this is the information that I was talking about that really shows me that I'm no longer worried, because they actually show us the quality of those loans in certain metrics. And I'm familiar with these metrics because of the industry I work in, banking. But it shows you here, middle market lending, the amount of money that they have invested, the percentage of the portfolio that's in, and the percentage that's investment grade versus uninvestment grade, upgrades versus downgrades. Across their total corporate lending portfolio, they've actually had more upgrades than downgrades. Credit losses, basically zero across the board. Subordination, which basically shows you like how much of the debt that the company has where that other person lending to them is going to take the loss before you. So that basically means like the first 14% of losses on this portion of their lending, they wouldn't even take the hit first. Like they wouldn't, it would be other lenders that take the hit first, the first 14% of losses. And like I said, they would have to see 20% of losses before the company would be wiped out, which means those companies would have to actually take 35% losses in order to destroy FG. Current non-accruals is 0.1%. And then also they show here the LTV ratio, which is loan to value, which basically means like the loan relative to the value of the assets. And if you kind of like work backwards from the metrics here, if you assume like a 15% interest rate, which would be a high interest rate for some of these companies, but it might actually be an interest rate for some of these companies. Because again, junk bond credit, quality credits at a 15% interest rate, and assuming a price to book of 1, and assuming liability to assets of about 50%, which those are big assumptions, you end up with an interest coverage ratio of like 1 to 2, which basically means that these companies can absolutely cover their interest costs with the amount of EBITDA that they currently have. And it shows here that the average EBITDA that they actually have is about $205 million for the companies within this area here. So I just threw a lot of information at you based off of this table right here, because like I said, I'm kind of somewhat trying to wrap up this discussion. But the point is, like, if you want to know why you shouldn't worry about FG's assets in regards to the whole private credit discussion, I would say look at this section of their presentation. Look at the investment section of the presentation, and look at like those pages, the investment pages, pages 24 through 29. I would say pages 24 through 29 in the presentation, especially page 28 is the pages where I would say is like, oh, okay. So they actually have really high quality loans. That's basically what I see when I read this page. Like I read this page and I'm like, oh, there's like no way that they're really going to lose money on these loans. Oh, okay. Right? Like it's basically like that much of a dumbfounding moment. Again, it's partially I feel that way because I literally look at these type of metrics for companies all the time in banking. So that's why I feel pretty confident. Like we would have to have a really, really, really devastating recession for this to go bad. It's basically what it shows me. But yeah, I'll probably go into more detail on this again in the future though. So that is that. But yeah, so that's going to be my rundown on FG in the short term. Yeah. Not a great quarter, like I said, especially in regards to the sales. And I get the feeling that there was maybe some speculation in the short run, people getting excited about maybe what was going to happen with the sales. I'm still looking to see that turnaround in the yield curve, the 10-2 yield curve, as we kind of talked about, which is depressed partially because of the energy shock, which I definitely am of the opinion that we probably will get less devastating effects from the energy shock than a lot of people think in the long run, partially because we will mitigate the effects of it better than people expect, and also because politics tends to fade in the long run too. So that means I am somewhat assuming that we will get some sort of resolution before effects become too devastating. And like, yeah, I know my room is getting so dark. If you're like looking at my camera, you're probably like, man, why is Derek so dark? Why is it so dark right now? It's like, well, sun is going down and my blinds are kind of shuttered and the light is off in my room here, and the sun was brighter when I started. So that is what it is. But anyway, the point is, yeah, we had a negative reaction to the earnings, bounce back here today, which in my opinion was very warranted because the earnings weren't that bad. It just wasn't a great quarter, but it was definitely, in my opinion, wasn't a bad quarter. And I expect it. I wouldn't be shocked if Chris Blunt, our CEO, ended up doing some more purchases here in the near term future. And I wouldn't be surprised if the company kept doing a buyback over the next quarter. And I'm hoping that we get better dynamics for annuities in the next few quarters going forward. I know I've been saying that for over a year now, so it is what it is, but hanging tight with FG. So that's where we are for now. But yeah, so that's going to do it for today. Thank you to anybody who watches on the replay or was watching live and just wasn't chatting with me. Please like the stream if you haven't already. Please join the Discord if you haven't already. You have to be added manually, so it takes time for me to get to you, but please do if if you're interested. Hit the PayPal link below if for some reason you feel like sending me money because you like what I do here. But all right, I'll catch you all next time. All right, bye.